All right, welcome back to the Open. We were talking about the outlook for the economy with Tom Porcelli of RBC Capital Markets. Our next guest, when it comes to the idea of a soft landing, thinks it's going to be pretty difficult given this ongoing hawkish tone we've heard from central banks like the U.S. Federal Reserve. So how do you play the markets? How do you position the portfolio? Let's check in with Seema Shah. She's Chief Global Strategist at Principal Global Investors. Seema, it's always nice to see you. And I guess just jumping right into the market story, because we've spent a lot of time here already today talking about the economic challenges and specifically the challenges for the central banks in navigating that so-called soft landing. What are you thinking about on the market side and where to be putting money right now?
Hi, thanks for having me on. Look, it's a tough time at the moment. So when we look across the risk asset complex, especially your traditional equities and credit, they're going to have a tough couple of months, certainly. We do believe that there's going to be further equity market declines through that June low, and then further. So this is probably not the time to increase your exposure, certainly to equities. Within the credit space as well, we are starting to think about this economic downturn, maybe even recession starting to form by the second quarter of next year. So although earnings growth has been very, very resilient, things are going to start weakening from here, which means that default risk is going to be on the rise. And from there, we would certainly expect that you could see a further widening in investment grade spread and, of course, in high yield spread. So this is a market that you want to be reducing some of your exposure to that credit side. Now, for securitized debt, on the other hand, there is a little bit of a credit risk, but it's less than IG, and certainly than high yield. So we are thinking more and more about increasing exposure to stuff like securitized debt, of course, U.S. Treasuries, because as you eventually get into that recession period, U.S. Treasuries should really rally. And then the other parts of the market that we continue to like is stuff like TIPS, given the close correlation. Now, beyond your traditional equity and fixed income, and this is where investors really need to start thinking outside of your standard box, it's really real assets that come into play. If we think out over the next year, even the next 2 years, just going by the Fed's own forecast, we are in a persistently high inflation environment. The Fed is going to be working hard, but it's still going to stay higher than where they want it to be. So this is a time when actually real assets, so things where you can get some kind of inflation mitigation, things like listed infrastructure, even commodities to some extent, are the areas that we are looking to increase exposure to, because that's what we think is going to play out well over the next 12 months or so.
Helpful context, and one of the things we talk about every day here because of the difference of the dynamics, say, of the Canadian stock market, like what is dominating an index certainly is something for consideration, especially when the S&P has that skew towards techs. Seema, let me ask you this. Just everyone's looking at the historical charts right now because if we're heading into a recession, what does that mean? I had looked back at the last 3 rate hike cycles in the United States. 2 of those ended in a recession. During the rate hike cycles themselves, the S&P actually was in positive territory. But it was once we got into that situation where the rate hikes played a role, there were other factors undoubtedly, but played a role in that cooling of the market optimism, you saw sizable declines for the S&P 500. Now, this time around, I guess we started this rate hike cycle in the United States in March. And since then, the S&P 500 is down 13%. Does that change anything? In other words, can we look back to historical rate hike moves and the recessionary risk and how the market reacts to that? Or because we've seen so much fear this year in the market, do we also have to at least consider that?
Well, it's interesting what you say. So as you said, in previous cycles, the markets have done well in the initial part of the rate hiking cycle. But that's because the Fed, other central banks, were hiking rates in order to loosen up that economy. Now, what the Fed has already been doing is actually hiking rates into a slowing economy, which is one of the reasons why the market hasn't done well. And also, of course, because we came into this year with valuations extremely, extremely extended. So as soon as you've got some kind of hikes being priced in, an aggressive hiking cycle nonetheless, it did mean that there would be valuation compression. And that's what we've seen so far this year. We haven't even started to see the earnings slow down. So if we are still expecting recession to come through next year, that is unfortunately the next leg to fall, the next shoe to fall. So I think this is an equity market valuation compression at this point in time. And then your next set of equity market declines is going to be driven by earnings weakness.
And it all makes sense. To counter it to a certain degree, though, I mean, the unemployment rate in the United States is still, what, around 3.5%? Like, for those who have been arguing, well, hold on a second, maybe there are signs of cooling, and undoubtedly we just went through a bunch of them over the last 20 minutes, but is there also that other side that argues that, well, because there is still a high level of employment, things are uncertain, but people, to a certain extent, might still have some cash in their pockets, maybe less than they thought they would at this point, but that can navigate things through, that worst case scenario that the market seems to be dreading now might not materialize?
So it's true to some extent, but actually the US economy's strength is unfortunately going to end up being its weakness, because the strength of the labor market, as you said, is very, very tight. It's very resilient, and consumers, because they're still employment is still so strong, they have been able to manage the various inflation pressures that they're facing. But unfortunately, this means that the labor market is tight, wage growth is tight, and therefore the Federal Reserve simply needs to keep hiking until they create that labor market slack. So we're getting to a point the Federal Reserve has to almost engineer that slowdown. So it's strong for now, but all that means is that the Fed has to continue hiking until they create that weakness. So it will come. It's just how long it takes for the Fed to get to that point, unfortunately.